Today we're talking about the biggest bad word of them all, IRS audits. Hi, I'm Nate. I've been a CPA for over 12 years. I'm the founder of Cookie Finance. We are an accounting firm that focuses exclusively on content creators, and we want to understand a little bit more about audits, what they mean, the red flags, so you're at peace of mind and you can understand what you need to do to avoid being audited. So before we dive into the red flags and what's going to potentially trigger an audit, let's actually understand what is an audit. What does it mean to be audited by the IRS? Because I think we all have in our mind that an audit means the IRS is going to show up in the middle of the night. They're going to, drag you out of bed. You're going to spend months digging through every single tiny little transaction, pouring over all your receipts that you kept in your shoebox. That's not really what happens, okay? So the first big thing to understand is only about 1% of all people actually get audited each year. It's a little bit different every year and it depends on the tax bracket, but you can actually look it up on the IRS website that about 1% of people are audited. Of those 1%, usually those 1%, they're getting audited for a good reason, which we'll talk about in a second. But there are kind of two different types of audits with the IRS. The most common one is what would be considered a paper audit. You get a letter from the IRS. They say, hey, taxpayer, we were reviewing your tax return and we noticed these few things on your taxes. Maybe we noticed that you had $20,000 of deductions for contractors. Can you support that? Can you back up that $20,000 for us? And you say, sure. And you mail them back a record of those $20,000 of payments you made to contractors. And you say, here's a backup. And they say, that's chill, you're good to go, and you're done. It happens, maybe out of 300 tax returns, maybe 2 or 3 people might get that. And it's really easy to clear up. It takes just maybe 30, 45 minutes. You mail it back to them. They clear you. You're good to go. That's the most common one. It's really easy. Nothing too bad. The more complicated one is when there are a lot of really, really big red flags on your tax return. And they say, hey, this is more than just 1 or 2 items we need clarity on. We're kind of concerned about the entire return because you took a lot of really aggressive different positions and we actually want to do a full audit. And what that means is you are assigned an IRS agent and you basically need to go through all the different line items you're deducting, all the income, every single transaction, tie it back to what it meant and justify every little thing for them. They're going to exclude, include all these different things and come to a final judgment of here's what you actually owe for your tax return. That one is brutal and can take a really, really long time. So that's the one we want to avoid, but it is super rare. We have done hundreds and well over 1,000 tax returns. We've never had a client actually go through that. It is a very rare thing to do, but let's actually talk about what are going to raise those red flags with the IRS. Probably the first big red flag as a creator is you try to write off your entire life. So you say, look, everything I do is for my content. Every Chick-fil-A every time I go to Chick-fil-A, that's my life. My entire house I bought is my life. This boat I bought, my car I bought, everything I do is for my content. And you try to write off everything. That is going to throw up so many red flags. And it's going to be a situation where you don't just have to justify 1 or 2 things on your tax return. You get a paper audit. That's going to be one of those things where it's going to look really weird. As a creator, you made $500,000 and you spent $600,000 on expenses. That's when the IRS is going to say, all right, bro, let's actually understand everything you did here. And let's really make sure every single thing you try to write off is deductible. If your expenses are more than 20, 30, 40% of your income, it's going to start to raise a little bit of red flags because as a creator, your expenses aren't super high. You still want to find lots of deductions. But if you try to write off your entire life, that is going to raise massive, massive red flags to the IRS. The other major audit risk is your vehicle. So vehicle can definitely be deductible so long as the vehicle is being used for business purposes. Now, Where it raises a big old fat red flag is you buy a brand new Mercedes G-Wagon, and then you say, do you know what? This G-Wagon is 100% used for business, so I want to write off all $150,000, and it's 100% used for business. I don't have any other cars, but I have this one G-Wagon, and I want to write off the whole thing. That's going to raise a lot of red flags. The IRS is going to be like, really? 100% of this vehicle is used for business purposes. You don't ever use it to run to the store, to run to the gym, do these different personal things, right? And was that really necessary that you got a G-Wagon? Was it an ordinary part of the business? So they're going to dig deeper and deeper into that expense and really force you to justify every single little bit of that. They're going to want mileage logs, all these different things to really justify you having that luxury vehicle. Another one, boat. Don't ever try to write off your boat. Please, for the love of everything, don't ever say your boat is business. Even if you do use it for business, unless you are a fisherman or you're like, fishing for lobsters, don't try to write off your boat, okay? Don't ever. Vehicle, be reasonable with it. If you buy a new G-Wagon, maybe only write off half of it. Maybe only 50% of it is used for business purposes. You want to make sure it matches and that you can justify it. That way it doesn't raise red flags with the IRS. But anytime you put vehicle, it raises an orange flag. As long as you're reasonable with that and you don't try to go too crazy, it won't turn into a red flag. It turns into a red flag when you try to write off 100% of it and it's a luxury vehicle and you try to get a little bit too cute with the vehicle deduction. The other one is not treating your content business like a business and treat it more like a hobby. And what we mean by that is you don't have an LLC set up, you don't have a separate business account set up, you're not doing quarterly taxes, you're not tracking your income and expenses on a regular basis, you are treating it like a hobby. And if you treat your business like a hobby, well, the IRS might also treat your business like a hobby. And the bad thing about that is if the IRS comes in, they say, hey, this is a great thing that you have going on. It's really cute that you're doing this content. And yes, I know that you made $100,000 this last year, but we're going to classify your business as a hobby. Now, why that's so bad is if the IRS says that you are a hobby, that means you can take 0 deductions. You can't write off a single thing, and you have to report 100% of that income as taxable income. So why they might consider your hobby is for all of those things I just talked about. They actually have a test that they go through. And so if you treat your business like a hobby, you don't have a separate bank account, you don't have an LLC, you aren't doing those quarterly taxes, all those things I just listed, then you run the risk of the IRS treating you like a hobby as well. And then you miss out on all of those deductions. So treat your business like a real business. Make sure you have all of those things in place. Another big red flag is trying to write off way more of your home than you should. So you can write off a portion of your home. Let's start with that. If you have a portion of your home that is dedicated to your content business, a home office or a studio, you can write off a portion of the home that is dedicated to that home office. Where you get in trouble is when you try to say, hey, 100% of my home is used for my business. I film content in my kitchen, in my living room, in my bedroom. 100% of my home is used for my content. I'm gonna write off 100% of my rent. That right there will raise the biggest red flag, and I can guarantee you're going to get audited. Basically, what the IRS says is they don't like to see you write off more than 300 square feet. It's not a rule, but they don't like to see more than 300 square feet. Anything below 300 square feet, green flags, you're good. They're not really going to raise a fuss about it. Anything above 300 square feet, it starts to turn a little bit into an orange flag with the IRS. They're going to pay a little bit more attention. They might have you justify why your home office is more than 300 square feet. If it's the entire home or 75, 80, 90% of your home, that's when it's going to be straight up red flags. And they are definitely going to ask you to justify why you feel 90, 100% of your home is 100% business use. Is that bathroom really 100% business use? Is your kitchen 100% business use? That's when you're going to start to raise massive red flags. So once again, similar to the vehicle deduction, you should definitely write off a portion of your home, but be smart about it and don't try to get too cute so it doesn't raise any orange or red flags with the IRS. Another big red flag is going to be not reporting all of your income. We've talked about this before, but you need to report every single dollar of income that you make from your content business to the IRS. What we've seen happen with a handful of creators who were doing taxes on their own, they get a 1099 from a brand and they say, I'm not going to worry about reporting that. It's only $1,000, $2,000. I'm not going to worry about reporting that. Well, the problem is the IRS gets a record of all of these. So what happens is the IRS gets a record of these 1099s. They then compare it to what you put on your own tax return, and they make sure that they actually line up. And if they don't line up, 100% the IRS will get back to you and say, hey, there is a mismatch between what we have and what you put. We went ahead and automatically adjusted your return, and here's the taxes you owe, plus the interest and penalties and fees for being late and not reporting that income. So a hilarious but true story was this past tax season, one of our creators forgot to give us one of their 1099s. So we didn't report that 1099 on their tax return. It was interest that they received from their savings account of $5. So they got $5 of interest from their savings account. The bank sent them a 1099. They forgot to give it to us. We didn't report it on their tax return. They got a letter from the IRS saying, by the way, you didn't report this $5. We adjusted your return and you owe like $1.56 in tax. Like, it was so petty, but that's what happens, right? Like, the IRS wants every single last little bit of dollar. So don't try to get cute and not report your income. They will find it. And the worst thing that you can do is not report this income. They start to dig deeper. They see a pattern of you not reporting income. That is called tax fraud. And that can get you into a whole bunch of different trouble. Now, if you try to get aggressive with deductions and things like that, that's tax planning, tax strategy. That's all legal. But if you are just straight up not reporting your income, that is tax fraud, and that could do a whole bunch of problems. It's going to raise a ton of red flags. So report every single dollar you earn on your tax return. The final one to avoid getting audited is making sure you send 1099s to all of your contractors. So you need to send a 1099 if your contractor is US based and you pay them more than $600. If those two criteria are met, then you really should send that contractor a 1099. And when you send them a 1099, you also send the IRS a 1099. Now, here's why that's really important. Let's say you paid contractors $40,000 last year and you didn't give any 1099s. That is a really big red flag to the IRS. And I can almost guarantee you the IRS is going to come back at you and say, hey, there's $40,000 of contractor payments, but there's no record to us. Can you please justify that? And then you're gonna have to go through the whole process of justifying that $40,000. So here's why they care about contractor payments. Because let's say I own a business and I made $50,000 this year and I pay my wife as a contractor. I pay my wife $50,000. So then suddenly $50,000 of income, I paid a contractor $50,000. I don't report that income in a 1099. I pay zero taxes. Because there's no 1099, my wife also doesn't report that $50,000 because there's no paper trail, right? Well, that means I could avoid a lot of taxes by not doing those 1099s and paying out to my grandma, my uncle, my brother, my niece, whoever it might be, and then there's no kind of trail. So the IRS really likes those 1099s to tie it back and make sure everything was legitimate and above board. It happened with one of our creators. She was working with a tax firm before us. She had $80,000 of contractor payments. The tax firm said, don't even worry about it. You don't need to worry about 1099s. You're good to go. And as soon as she joined us, almost immediately, she got a nasty letter from the IRS saying, you have $80,000 of these payments. We need you to justify all these things. We need you to do all these 1099s. She had to then go back, get all the W-9s from the contractors. It was a whole headache we had to deal with. and it raised a bunch of red flags for her. And then the next year, even though we did everything right the next year, because she was on the IRS's radar, she got another letter asking her to justify it, even though we did everything right the next year. So once you kind of are on the IRS's poo-poo list, you kind of stay on that poo-poo list going forward. So if you hit those thresholds, US-based contractor, and you've paid them more than $600, please send them the 1099. That will avoid a lot of headache and give you all green flags and not have to worry about being audited. So audits, nothing to be scared about. If you are doing everything correctly, you are doing things by the book, you should never be scared of being audited. And this is where we really recommend working with a tax professional like Cookie Finance, who can make sure that you're doing things by the books, you're doing things above board, while still maximizing all of your deductions, being smart with your strategy, optimizing your taxes so you're paying as little to the IRS while still staying above board. But as long as you are doing or avoiding those 6 things we talked about in this video, you should be in a really good spot and you should avoid being audited by the IRS. But if you have any questions, please reach out to us, cookiefinance.co, set up a free consultation with our team. We'd love to talk with you about your situation and how we can help you with your taxes.
Tax, bookkeeping, and accounting services exclusively for content creators and influencers. That's Cookie Finance.